All right, guys. Good morning, good afternoon, good evening, wherever you are watching me from. My name is Oladejo Steven Anoluwapo. I'm privileged to be the founder of TGM Institute. TGM Institute is an academy that is dedicated to add value, that is dedicated to adding value to young minds through training them in the cryptocurrency, blockchain, and the forex market. So that's what we are dedicated to do. So in today's video, I will be walking you through the basics of forex. Yes, the basics of forex. And the reason why we'll be doing it that so many have been wanting to go into the forex foreign exchange market. And before you can go into the forex trading, then you need to have your basis. The basis of forex trading is just like your foundation, and your foundation needs to be strong before you can build something on it. If your foundation is not strong, when you build something on it, there's a tendency that that building is going to what? Is going to fall. There's a tendency that that building is going to what? Is going to collapse. So in this video, I will be walking you through the basics of forex trading. All you need to know in order for you to scale in the foreign exchange market, all you need to know in order for you to be a profitable trader in the foreign exchange market based on the basis. So I will be walking you through that in this video. So let's proceed, guys. So, do you want us to help you get better as a forex trader, or are you new, or you are struggling to make profit in the trading industry, or are you willing to take your trading skills to the next level? Then, yeah, is what TGM Institute has to offer you. So if you want to scale your trading skills, if you want to be a profitable trader in the forex market, don't worry, TGM Institute is here for you. But in this video, we'll just be walking you through the basis of forex. And in order for us to make you a better profitable trader, this is what we have to offer you. In summary, we teach you how to find potential trade setup. We teach you how to maximize your profit and cut your losses. We teach you how to achieve trading discipline. We teach you how to build a viable trading system, and we teach you how to earn consistent profit and avoid costly mistake. So we'll be discussing this at the end of the video. So let's go into what we have for today, which is the basics of forex. So in this video, in this training, this is everything we'll be talking about in this video. That is the introduction, what is traded on forex, who is the forex broker, trading section, trading terminologies, funds of trading, currency pairs, what is a PIB, bid and ask price, what is a spread, trading orders, take profit, stop loss, leverage, lot size, risk management, trading plan, strategy, and your MT4, MT5 interface, which is your trading platform. So this is all we'll be covering in this video. So I will try as much as possible to break all these concepts down into a simpler form. I will try and break it down into a layman language so each and every one of you can have a better understanding of it. So let's proceed. The introduction. I want you to know that the foreign exchange market margins carries a high level of risk. Yeah, you might have been hearing that people can make a whole lot of money in the forex market. Yes, it is true. At the same time, do not forget you can also lose a whole lot of money if you don't have the proper knowledge, if you don't have the proper risk management, if you don't have the proper knowledge on your trading setups and all of those things. So there's a tendency in order for you to lose money in the foreign exchange market. But if you have the valuable information you need on this largest financial institution, that you are going to what you are going to scale through, and that is what TGM Institute has come to what to impart: the humble, the ready, the available, and the teachable. So we are here to what to add value to humanity generally. So let's go. Let's dive into what we have. So what is forex? Forex is a short word for foreign exchange. FX is a short word for forex. So whenever you see somebody using the word forex, using the word foreign exchange, or using the word FX, they are all talking about one thing, which is what? Which is the what? The foreign exchange market, the foreign market, the forex market. So that's forex for you. And forex is the largest centralized market in the world with daily liquidity of about $5.3 trillion. So this statistics is gotten as at the time of preparing this slide, so it might have changed, either it reduced or increased. So that's forex. And permit me to tell you that probably in one time or the other you've performed what we call the foreign exchange. Let's assume if you have ever traveled to another country, that country you are traveling into, you have to change the currency that is with you to that currency of that particular country. And the moment you are doing that, you have performed what we call what? Foreign exchange. You have performed what we call the what? Forex, but it is done physically. Let's assume you have 1.5 million naira with you and you are going to the United States. You have to change your 1.5 million naira to a what? To the US dollars. And let's assume the $1 to the Nigerian naira is $1 to 1,005 naira. So automatically your 1.5 million naira is going to give you $1,000. So when you do this, you automatically what? Perform what we call what? Forex, but you've done it physically. So that's simply forex for you. So what is traded in forex? The simple answer is what? That currency is what is traded in the foreign exchange market. But in this video, but what we'll be doing now, you are not buying anything physically. You are not going to the bank, you are not going to the chain, though there are some people that are doing it as business. But here everything we'll be doing is digital. We'll be doing everything what online. So I believe that country's economy is doing well and will even get better as time goes on once we sell. So forex market is that we believe that when we buy a particular currency, we believe that the economy of that country is going to do well. And when the economy of that country is doing well, automatically that currency will also be what will be doing well, which will end up us in what? In profit. So, who is a forex broker? A forex broker are those firms who give us access to the what? To the forex market. We have access to the forex market through forex broker. Now, who is a forex? Forex broker are licensed firms. They are firms that are licensed, and they give you access to the what? To the forex market. They give you access to the market by providing a trading account for you, and they give traders what we call leverage. Or we will be looking at the concept of leverage before the end of this video. So they also provide support functions to traders, and we have various brokers on the forex market, and some of it we have NX, we have what forex, we have Deriv, we have Fuel Trade, and the likes of them like that. So what's trading sessions? We are entering into the most part of this forex training, so do well to pay attention. If you are distracted before, let's focus your understanding so you can get to know, because the trading sections will determine if you actually know the forex cycle. So the various trading sections, the various trading times and trading section we have in forex, they include one, the Sydney section, two, the Tokyo section, the London section, the Frankfurt section, and the New York section. So those are the sessions we have, and these session names are derived from the major cities in which most of these transactions are done. For example, the Sydney section, it represents the Australia and other countries around that time zone. When we are talking about the Tokyo session, sometimes called Asian session, it represents the Japan, the China, and some Asian country as well. So when we're talking about the London session, it represents the United Kingdom and the countries within it. So we are talking about the Franco section, which is Germany, represents the what? The Europe. And we are talking about the New York sections, it represents the America. So forex is traded, is actually a 24 market, a 24 hours market, 5/7. That is, it's traded 5 days. That's Monday, Tuesday, Wednesday, Thursday, Friday. So on Friday night, the market is going to close. On Sunday night, the market is going to open again. But we have some scenarios now. Those traders who trade the synthetic indices, they are brokers, they are called mob with instruments which news or something does not affect. So those type of markets, they traded, they don't close, they don't open. So they trade 24/7. But when we're talking about the currency pairs market, they trade for 24 hours, 5 days in the week. So it is only no matter the time zone, you can actually trade this large high liquid well. Let's get to know their trading times because each of these sessions have their opening and closing time. All sessions last for 9 hours. Every of the sessions we mentioned they last for 9 hours. And when you know the openings of these sessions, you can get them online. You'll be able to know their closing time. And one of the reasons we try to know the trading session, it is because we maximize it when two sessions are open. Because when two sessions are opened, there will be volatility in the market. The market will be moving very, very fast. So you get to know the opening sessions of some trading sessions and their closing time, and get to know when two or three sessions will be open at the same time, because that's the best time traders like to trade, because the market will be what we have will be volatile. So that is the essence of trading sections. And also we have some trading terminologies in the forex market. So whenever your fellow traders are saying something, so you'll be able to what to get what they are saying. So whenever a trader or analyst is saying I'm going long, it means he or she wants to buy a particular currency pairs. When so let's assume I said I want to go long on Euro USD. That means I want to buy Euro USD. And when I said I feel like shorting Euro USD, or let me short Euro USD, that means I'm saying I want to sell Euro USD. So that's some of the terminologies. We also have what we call the bullish market. Whenever you see somebody making use of the bullish market, that means the market is moving in an upward trend. The market is going up. And whenever you hear the bearish market, that means the market is what is going downward in a downward trend. We also have the bulls. The bulls means the buyers. The buyers are referred to as the bulls. The bears are referred to as the seller. So whenever a market is saying it's ranging, that means the market is consolidating. It is not going up. It does not have a particular direction. It is not going up. It is not going up. So we also have some other terminologies. You can get them to get yourself acquainted with it. The forex trading terminologies. So we have forms of trading. We have the technical analysis, we have the fundamental analysis, and we have the sentimental analysis. Let me show you what the technical analysis looks like. So this is example of a technical analysis. So I made this analysis I think some weeks ago, and I said, okay, if price is going to come to this line that I draw, price should sell from there. So technically analysis is just basically using the past information of a particular pair to what to predict the future price. So that's just technical analysis with you. So and some trader uses so many different strategies to what to analyze the market. Some people use what we call the trend line, some people use indicators, some people use the ICT concepts, that's the smart money concept. Some people use the ICT, which is the international concept and stuff like that. So we have different terminologies that people use to trade the forex market. So this is the forex market. Also, and this is what we call technical analysis. So let's go back. So another form of trading we have is what we call the fundamental analysis. The fundamental analysis is the type of trading that we trade with news. Yes, there are some sites you can use to monitor the news of a particular nation. So when a particular nation when we have positive news in a particular country, it might affect the currency of that nation either positively or negatively. Are you getting it? Can affect it positively or negatively. So that is when we have what we call fundamental analysis and also sentimental analysis. Sentimental analysis is just the type of analysis when one, two, three, or four traders are saying the same thing, like no, Euro USD is going to buy, is going to go long, is going to go bullish, and all of those things, and you heard and you decided to what? To trade the market sentimentally. I don't know if there's any English like that. So these are the forms of trading. That means before you can trade the forex market, you need to understand one of these, or probably understand the two, or even the trade. Nobody will prosecute you for that. So let's move to currency pairs. Currencies are traded through a broker or dealer and are traded in pairs. So currency pairs are traded in pairs. You just cannot just trade one. You trade it in what? In pairs. For example, we have the euro and the USD, that's the whole USD. We have the British pounds and the Japanese yen, that's the GBP, JPY. We also have so they are traded in pairs. So we also have what we call the major pairs. These are pairs which include the US dollar in them. Whenever you see US dollar in a particular currency pairs, they are called the major pairs. And traders like to trade the major pairs. Why? Because they are the most liquid and widely traded currency pairs in the world. So we also have what we call the crosses or minus pairs. They are the pairs without US dollar in them. Like example, the Great British Pound, the British Pound and the Australian dollar, or the Euro and the Japanese yen. That's the GBP or Euro JPY. So those are the short forms of them. So whenever you see currencies where the US dollar is not in them, that means those currencies are what we classify as the minors pairs. Also, we also have exotic pairs. These are pairs that consist of the US dollar and currencies of country with emerging economy. So whenever you have US dollar and countries that are just emerging in economy, then we classify those pairs as what? Exotic pairs. Example, we have the USD PLN, that's US and Poland currency. We have the USD RUB, that's the US and the Russia. We have the USD and ZAR, that's the US and the South Africa. And we have many more like that. So you can check more concerning them. So what is a P? Um in this call, if you miss this concept of PPA, believe me, your foundation is going to be shaky all through your forex journey. So pay attention and get to understand what we understand as PIP. So PIP stands for points in percentage. Currencies are gauged in PIP. Trade orders are placed in PIPs. Profits are calculated in PIPs. Practically everything we'll be doing in the forex market involves PIPs. A pip is the smallest unit in which a currency pair can change. It can also be said to be a standardized unit and the smallest unit amount by which a currency pair in the forex market can change. So most of the currency pair we start calculating the pips from the decimal place, but there are few exceptions. And the exceptions are pairs with JPY in them, JPY pairs. JPY pairs are calculated from the second decimal place, But majority of the currency pairs are calculated from what? From the fourth decimal place. And we also have exceptions like gold. Well, some brokers treat gold as like JPY pairs, and some broker calculate pips for gold from the first decimal place. Let's see if I can show you example of what I'm saying. Okay, let's make Euro USD as an example. This is the bid price of Euro USD. That is 1.162. Let's make use of this. It is 1.1. So you can see it very well. 621. So this is the price of USD, Euro USD. So if the price of Euro USD is going to move in one pip, just because we are calculating this from the fourth decimal place, that means this one is going to change to 2 if it's going to move in one pip. Are you getting it? With this price now, with this price you are seeing on the screen, if the price of Euro USD is going to move bullish, is going to go up in 20 pips, that means this price is going to change to 1.16, then it's going to be 42. That means it has moved in what? In 20 pips, because we're calculating it from the what? From the fourth decimal place. So if the price of USD is going to come down by 10 pips, that means you just minus 10 from it, because it is being calculated from what? From the fourth decimal place. That means you will now have what? 3 2. So that is how pips is being calculated in every of the things you will be doing. So, and the JPYPS, don't forget I said they are being calculated from the second decimal place, and same thing as gold, but some broker trade gold from the first decimal place. So currencies are listed in pairs such as um, Australian dollar, Canadian dollar, AUD, CHF, Euro USD, GBP USD, NZD USD. The first currency within the pair is the base currency, while the second is the quote currency. Like I showed you earlier, like Euro USD. So Euro is the what? Is the base currency. You can see this. Euro is the what? Is the base currency, while USD is the what? Is the quote currency. That means Euro is stronger than US dollar. Are you getting it? So we also have USD JPY. You can see this here at the top here, USD Japanese yen. That means USD is the base currency, while the Japanese yen is the quote currency. So that currencies are always in pairs. So when we are talking about the base and quote, the base simply means the currency that is strong, while the quote is the what? Is the currency that the base is stronger than. So let's move. We have what we call the bid and ask price. In forex, the bid and ask price work same way. So the bid price is the price that buyers are also in the forex market are willing to buy, and ask price is the price that the seller are willing to sell. Yeah, buyers and seller are not human beings. It's the market. In this case, you buy from the market and you sell to the market. So this meaning is that when you place a buy order in the forex market, it will activate for you using the ask price. Remember that the ask price is the price that seller are willing to sell to you. You are the buyer. So you are buying from the market. So when you want to buy from the market is going to sell for you using the ask price. But if you want to sell to the market is going to buy from you with what? With the bid price. Do you understand? So that is bid and ask price. Let me show you an example of it. I think we saw it. You can see here bid. So these are the bid price, and this is the what? The ask price. So that's that. Okay, I don't know if we can see it here. Okay, we can't see it. So that's what we know as bid and ask price. So let's continue. So the bid and ask price, let's assume the USD NGN 357.5. I will join you soon, sir. I will join you soon, sir. I'm in a live meeting. So you can see USD NGN 357.45 to 357.98. So USD NGN, the USD is the base currency, while the NGN is the quote currency. So the first figure in this case is what we call the bid price, and it is the price that is triggered when you place a sell order. While the second one, which is 35798, in this case is the call the ask price. It is the price triggered when you place a buy order. So understand this very well. So bid and ask price are prices from the perspective of the broker. Traders sell currencies at the bid price and buy currency at the ask price. So if you have seen it, you would have seen it. Whenever you go to the bank, you will see a board displaying exchange rate. So the bank will be buying dollar from their customer at the rate of 340. That means if you want to go and sell dollar to the bank, they will buy it from you for 340. And when that same customer goes to the bank to buy that same dollar, the bank are going to sell that dollar to you for 360. You would have seen their exchange rate on the what? On the board. So the difference between the 340, which is the bid, and the 360, which is the ask price, is what? Is 20 naira. So that 20 naira is what? Is the profit of the bank. And that profit of the bank, which is 20 naira, is what we call uh all right. So that 20 naira profit is what we call the spread. So that profit is what we call the spread. So spread is the difference between the bid and ask price. It is usually the profit made by the broker. So the broker that is giving access to the market. So that's where they make their money from the spread. So the difference between the bid and ask price is what we know as the spread. So don't worry, we'll make use of a regulated broker that charge a relatively smaller spread for each trade you take, so you don't find yourself paying too much for every position you open. So we'll be making use of NX to trade the currency market, and we'll be making use of deriv to take the synthetic for as many who are interested in trading the synthetic market. So spread varies between trading sections. So when volatility is high, when markets are open at the same time, the spread is always small. That is another advantage of trading when markets are open. So let's go to what we call the trading orders. So in trading orders is just forms of trading, how you can trade. And we have what we call the take profit, we have what we call the stop loss. Take profit is the point you set, or the particular price you set, that the market should close you in profit. So whenever the price you set, whenever price move and get to the price you set, price will automatically close you from that trade and keep your profit for you in your account. Same thing as stop loss. Any price you set that the price should close you, it means that when the price get to a price you set for stop loss, the price should stop you from making further loss. So that is trade profit and stop loss. I have a video have explained these trading forms, how you can trade, um how you can set your take profit, your stop loss, your buy limit, your stop limit, and every of those things. So the video, check through my channel if you're going to see it, or probably join our Telegram channel and it will be dropped there, or somehow you request in the comment section. So you are going to get it in order for you to have more knowledge on the trading orders. So we have what we call the leverage. Leverage is the ability to use small thing to control something big. In this case, using a smaller capital base to control a larger lot size. To understand this concept of let's trade, let me quickly walk you through the brief history of forex. The thing is that initially forex, it is not anyone that is allowed to trade the forex market. Just as we see currently in the New York Stock Exchange, forex are only traded by people we call the cabals, men of the street. They usually what? They are investment bank, they are rich men, they are monarchs, big businessmen, company owners. So those are the people that are allowed to trade through forex market as well. Let's take for example the New York Stock Exchange, for example. For you to trade in the floor of New York Stock Exchange, you need to be making millions of specific amounts of millions of dollars per annum. You should not be owing any mortgage. Your tax documents are up to date with so many criteria. So that is when you'll be able to trade the what in the New York Stock Exchange. Same thing as the forex market before. It was the elite that trade the forex market then. So a retail trader like you and I are not allowed to trade the forex market. But during the invent of internet, the world became a global village in that you and I can buy and sell from everywhere around the country. So the broker will give us leverage as individuals to be able to trade the market with a small capital. So instead of individual trading with $1 million, you can actually place a trade with as little as $10 because you didn't go alone. You went with your what? With your broker. So now your broker allows you to trade because he offers you what they call leverage in the forex market. So the principle of leverage is virtually multiplying that your little capital so that you can use it and buy something worth bigger value. For those who have opened so if you have probably opened one broker before or something, you would have seen something like 1 to 100, 1 to 500, 1 to 1000. So they are leverage that the broker are giving you. So I will recommend NS and Deriv. I'm going to drop the link you use to open these brokers in the comments, so in the description. So do well to click on it and register with them. So I'll also drop the link to our Telegram channel. Do well to join our Telegram channel as well, so you can get updates on how the forex market is going and all of those things. So in the forex market, the higher your leverage, the more you need your small capital can trade. So I think the last thing we'll be talking about is the lot size. So this is the amount of quantity of a trade that you bought or sold. Is sometimes called your position size or trade size. So we have different lot size. We have the standard lot, mini lot, the micro lot, and the nano lot. And we have, this is their unit. We are talking about standard lot. We are talking about 100,000 units, which is the volume is 1.00. That means when your the price when you trade, when a currency pairs move in one pip, either in profit or in loss, if you make use of the standard lot, which is 1.00, you will be making $10 either in profit or in loss. If you make use of the mini lot, which is 0.10, that means you will be making $1 in every pip, either in loss or in profit. Macro lot, it means is 0.01, that means you will be making 10 cents in every pre movement of every currency trade you open. Then the nano, we have 0.001, that means you will be making 1 cent in every pips move, either bullish or bearish. So that is lot size. So before we go, I would advise you check the description. You see the link to the recommended broker. Try as much as possible to register with them. Also, I'll be dropping the Telegram channel link in the description. Try as much as possible to click on it as well to join our platform. You'll be getting updates on the forex market. And also, yes, this is just the basis of forex. So if you are going to trade the forex market, is either you get signals, what we call signals to trade, or you learn how to analyze the market yourself. So TGM Institute is going to be doing these two for you. If you are ready to further your trading journey, if you are ready to take your journey, your first journey to the next level, then do well to click on our Telegram channel. Though the signals are the um teaching of how to analyze the market yourself, they are not free. They come with a price. So this is where we'll be drawing the curtain for today. Thank you for choosing to learn from me. I still remain myself, Oladejo Stephen Anoluwapo, the founder of TGM Institute. So before you go, guys, do well to click subscribe to this channel, like, share this video, and also turn off the post notification bell, so whenever an educational video is being dropped on this platform, you'll be notified. So share it to your friends that you know is interested in forex trading. This is actually where you will be starting from. And if you have any question, do well to drop it in the comment section, or probably join our Telegram channel in order for you to have more knowledge about what we are discussing. All right, thank you very much for the last time. Bye.